The first time I learned about index funds was back in 2015, actually from this man, Warren Buffett. And he said everyone should invest in the S&P 500 index fund. Those were his words. And it was actually the very first index fund I ever invested in my Roth IRA back in 2016. And if you don't know who this guy is, he is basically a legend in the investment community. And I always make sure to tune in to his annual shareholder meeting with Charlie Munger at Berkshire Hathaway. There are a lot of you out there watching this video who may be brand new to the investing side of the world. And I get a lot of you in the comment section not fully grasping the fact that index funds can be both ETFs or mutual funds. So again, an index fund can be either a mutual fund or an ETF, which stands for exchange traded fund. And they're passively managed because an index fund, whether it's a mutual fund or an ETF, will try to match the performance of a specific market benchmark or index as closely as possible. So if I see an S&P 500 index mutual fund or S&P 500 index ETF, their ultimate goal is to match the performance of the S&P 500 index that I always see on the news. If the S&P 500 is down 1% today, then my S&P 500 index fund is most likely down 1% as well. If it's up 2%, then my ETF or mutual fund is also up 2%. My index fund can also be either stocks, bonds, or a combination of both. I'm also going to explain that in detail in the next segment. So be sure to subscribe if you haven't done that already. And the next thing about the index fund is that it's much more tax efficient than the actively managed fund because the portfolio manager trades less frequently. An index fund just tries to match what the market index does. So if you have an S&P 500 ETF, it just follows the S&P 500 chart. If the S&P 500 takes out a stock inside that, then the S&P 500 index fund will match the same thing. An actively managed fund can also be either a mutual fund or ETF, but the portfolio manager picks and chooses specific stocks or bonds inside the fund to try to outperform the market index. So if the S&P 500 index fund is performing 15% so far in 2023, then the actively managed fund will try to outperform the index fund with 16, 17, 18% or more. But the downside of owning an actively managed fund is that it's not very tax efficient because the fund manager will most likely trade more often than the index fund. When the fund manager sells stocks inside a mutual fund or ETF, then I'm going to have taxable capital gains by the end of the year. If I had to invest in some kind of actively managed fund, then I would invest them inside my Roth IRA or HSA so I don't get a tax bill every year. And not to mention that most of the actively managed mutual funds or ETFs don't outperform index funds. Index funds actually have been outperforming 80% of the time, and they're so much cheaper. And speaking of a Roth IRA, let me give you an example of how an index fund works inside my Roth IRA. A Roth IRA is my investment vehicle. It's not an investment, but it's a vehicle that can carry all kinds of investments. So what I do is that I contribute from my checking account to the Roth IRA. When that money gets transferred to the Roth IRA, it actually just sits in the money market account inside my Roth IRA. It's not in any investments just yet. And once I have money inside the money market fund of the Roth IRA, then I have the option to pick and choose mutual funds, individual stocks, bonds, or ETFs. So this is when I get to invest inside my Roth IRA. And I can even choose bonds ETF or mutual funds, index equity ETF or mutual funds, actively managed ETF or mutual fund, or individual stocks. It's completely up to me. And once I made my initial investment in my mutual fund, only mutual fund, then I can actually start making automatic contributions directly from my checking account to the mutual fund. And I can actually bypass the money market fund so that I can have the money directly invested in a mutual fund without even thinking about it. So what I've been doing is investing $250 every 2 weeks directly into the mutual fund on an automatic investing schedule. Out of sight, out of mind is the way to go. I never have to worry about when I'm gonna dollar cost average my contributions. But can I do automatic investing with an ETF or individual stocks? The general answer is no. I can't directly move money from my checking account directly to an ETF in my Roth IRA or taxable brokerage account or any other investment vehicles. I have to trade my ETF from my money market fund like an individual stock when the stock market is open between 9:30 a.m. and 4:30 p.m. Eastern Standard Time. But let me show you a trick that I did to make ETF investing somewhat automatic. And this is just a bit complicated, so just bear with me here, okay? And this is a screenshot from Charles Schwab when I make a trade. I blacked out the ticker symbol because I don't want you to think that I'm providing specific investment advice. This is just to show you how it works. And if you look at the top of the screen here, you see where it says $224.41. That's how much money I have in my money market account. So that's how much money I can trade right now. And if you look at the middle of the screen here, it tells me the current price per share for the ETF I selected, and it's currently trading at $73.53 at the time I took the screenshot. So each share I buy will cost me $73.53. So since I already have $224 in my Roth IRA, money market fund, I could do what's called a limit order right here instead of the market order. So I could put a price of, let's say, $73.50 or below the current market price to lower the total cost basis. I could actually buy up to 3 shares as long as it doesn't exceed $224 that I have in my money market fund. And what's kind of cool about this is that I can set the timing to one trading day right here where it says day, okay? And have Schwab execute the trade at the share price that I get to dictate. Or I could select what's called GTC. And you're gonna see on the next screen, but I'm gonna write down GTC here. And it stands for good till cancel. And this is the screenshot from Vanguard. The concept is entirely the same with a different format. But before I go over this, don't forget that you can download all of my financial resources for absolutely free by visiting firesightchat.com/resources. You should also check out my Fireside Chat shop if you're curious about what equipment I use to grow my YouTube channel from 700 subscribers to 10,000 subscribers in a year by visiting firesightchat.com/shopping. I can do the limit order, and let's say it is $425 with the GTC. Again, that's called good till cancel for up to 60 days. So what this means is that I'm telling Vanguard that I want to trade $425 in share price when this specific ETF starts trading at or below $425. Do you see how this share price is at $425.52 right now? So when this share price hits $425, then Vanguard will automatically execute this trade at $425 or below. If the market opens at 420, then it's going to execute at 420. And if I set my trade order 60 days GTC, I could even set a customized expiration date on when I want the broker to execute this limit order. And lastly, this is a screenshot from Fidelity. The only difference is that I can make a limit order trade for up to 180 days. And I think Fidelity has the most flexibility, but either one really works. So this is one way to automate my ETF investing with the money I already have contributed to my Roth IRA money market fund. So some people just don't want to deal with it and just trade it on the same day they contribute to the Roth IRA. This is completely up to you. If you don't feel like doing all this work, then maybe consider doing the mutual fund instead, right? But 401k plays a little differently than a Roth IRA because most 401k investments are picked and chosen by my employer. The options are mostly limited to actively managed mutual funds unless my employer and my 401k have a contract to allow me to invest in their index funds. It all depends on the type of broker I have. But generally speaking, this is how a typical 401k works. My pre-tax money will go into my traditional 401k. Then I could also have my employer's profit sharing or employer match into my traditional 401k. My after-tax dollars or income will go into my Roth 401k. So I'm paying income taxes now, so I don't pay any taxes later in retirement. And what happens to my 401k contributions is that basically they both go into a 401k core fund. And inside that core fund, my money will be automatically invested into the pre-selected mutual funds that my broker picked for me, unless I personally log into my 401k account to change my allocation strategy. And when I had a Vanguard 401k, I had a mix of target date retirement fund, a Vanguard S&P 500 index fund, and an international growth fund. And Some 401k brokers like Vanguard allow me to open what's called a self-directed 401k. Basically, I had to keep about 10% of my money in the 401k core fund and invest the other 90% into the self-directed 401k. That's just with Vanguard. I don't know how it works with Fidelity or Schwab, so make sure to read up their plans if you're not sure. And that 90% allow me to invest like a regular brokerage account and choose ETFs, individual stocks, and index mutual funds. But keep in mind that this self-directed 401k is only available if my employer allows it. It was a great option for me because I am an experienced investor. This isn't necessarily a good idea for everyone, especially if you're at the beginner's level. And if you have an HSA or a health savings account, you'll actually have the option to invest in mutual funds or ETFs if your HSA allows it. Typically, I contribute to my HSA directly from my pre-tax income and my employer contribution under the high deductible health plan, and they're both in pre-tax dollars. And these pre-tax dollars will then go into my HSA checking account, and I get a debit card from my HSA so that I can use it to pay for medical expenses. But instead of using my HSA to pay for my qualified medical expenses, I just invest what I contribute directly to the investment account inside my HSA. And I did a detailed video on the HSA, so I encourage you to check out my HSA playlist after watching this video. And once I have my cash in the HSA investment account, then I can invest in ETFs, stocks, or index mutual funds. But keep in mind that some HSAs won't allow you to invest the entire amount. My HSA, for example, requires me to keep $2,000 in cash in the checking account and invest the rest. This is a great way to grow my HSA over time so that my cash doesn't lose value to inflation. And what's also awesome is that if I invest in a mutual fund, my HSA allows me to schedule automatic investments weekly, bi-weekly, or however I want it. And at any time I want to cash my investments out of the HSA to pay for medical expenses, I can sell my investments and then put them in my HSA checking account. I don't owe any taxes on the dividend reinvestments or capital gains every year. And if you're curious about your eligibility to join my private client program to discuss these things in depth, you can schedule a free 20-minute session with me by visiting buyersection.com/coaching. But before you start doing any research on mutual funds or ETFs, you have to have a clear understanding of how your investment vehicles like Roth IRA, 401k, HSA, and taxable brokerage account work. Because with a Roth IRA, I have almost unlimited options to invest in either mutual funds or ETFs. With a 401k, I'm most likely going to have limited investment options dictated by my employer unless they allow me to open a self-directed 401k account under their management. And I'm also going to keep in mind about tax efficiency when it comes to investing. If I'm investing in something that's going to create short-term or long-term capital gains, I'm probably going to use HSA or Roth IRA, so I don't need to pay as much taxes on the distributions or dividend reinvestments. In my taxable brokerage account, I would probably rather invest in low turnover ratio index mutual funds or ETFs. I'm not telling you what to do. I'm just sharing what I'm doing that works for my financial situation. Remember to never invest in something you don't understand. It's called gambling if you do. And I want you to make educated and well-informed decisions before you put your money into a mutual fund or an ETF.